Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about DOMINOS Pizza Inc. quarterly report. Domino's Pizza Inc. offers a wide range of businesses and services, including pizzas under the Domino's brand name, bread products, wings, boneless chicken, pastas, oven-baked sandwiches, dips, soft drink products, desserts. The Domino's Pizza Inc. DPZ stock price has experienced significant negative changes in the past year, with a minus 1.58% decrease and a total shareholder return of minus 3.6%. Despite this decline, there were several factors that contributed to periods of relative stability within the broader decline or events that had a less dramatic impact than expected. One key factor was the mixed Q3 2025 earnings report, which showed stronger than expected profit and U.S. same-store sales, but missed estimates on international same-store sales. Analyst price target adjustments also played a role, as several analysts lowered their targets due to macroeconomic headwinds and competition. Domino's continued focus on digital upgrades, third-party delivery integrations, menu innovation, and brand refreshes were seen as multi-year growth drivers. Additionally, the company maintained consistent dividend payouts, providing a level of support for the stock price. The Q2 2025 performance showed better results, with U.S. same-store sales growth of 3.4% and total revenue up 4.3%. The Q4 2024 performance also generated operating revenue of $1.44 billion, up 2.8% year-over-year. These events suggest that while the stock price declined overall, there were periods of relative stability or temporary recoveries due to positive developments and strategic initiatives. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by an increase in same-store sales, expansion into new markets, and higher supply chain revenues due to increased order volumes and food basket pricing. Additionally, U.S. franchise royalties and fees have seen a 10% increase, while international franchise royalties and fees have grown by 5%. The U.S. store segment has experienced revenue growth of 13%, with the supply chain segment growing by 1%. On the other hand, revenue decline is primarily attributed to the refranchising of company-owned stores, resulting in a 7.2% decline in Q3 2025 and a 2.7% decline in FY 2025. The supply chain intersegment revenues have also seen a significant decline of 185% from Q3 2024 to Q3 2025. Overall, the key drivers of revenue growth are related to sales and supply chain performance, while refranchising and intersegment revenues are the primary causes of decline. The company is indeed generating positive operating cash flow, as evident from the financial summary. The data on page 5 and page 28 confirms this trend. In 2025, the net cash provided by operating activities reached $552,256, or $552.3 million, a significant increase from $446,879, or $446.9 million in 2024. This upward trajectory suggests that the company's operations are generating sufficient cash to cover its expenses and investments, indicating a healthy financial position. The company's financial summary reveals a mixed picture regarding its debt level and interest expenses. While the long-term debt has increased significantly from $3,825,659 to $4,810,274 over time, there is no indication of a significant change in recent periods. In fact, page 24 states that there was no significant change in debt level or interest expenses. However, it's worth noting that the company's net cash used in financing activities increased by $245.2 million, indicating an increase in borrowing. On the other hand, interest expense has shown a slight decrease of minus 0.64% and a minor increase of 1.4% in recent periods. Nevertheless, page 30 warns that interest expenses may rise due to variable funding notes with fluctuating interest rates. Overall, while there are some fluctuations in debt level and interest expenses, the changes are not significant enough to raise major concerns about the company's financial health. The company's financial performance reveals a mixed picture across different segments and regions. On the positive side, international franchise and supply chain segments/regions excelled with significant income contributions. In contrast, U.S. company-owned stores and U.S. region as a whole underperformed, indicating areas that require improvement. Management is optimistic about the company's outlook, driven by its hungry for more strategy. Key objectives include increasing sales, expanding stores, and boosting profits through a focus on operational excellence, renowned value, and best-in-class franchisees. The company aims to achieve global retail sales growth, excluding foreign currency impact, and plans to expand its international presence through franchising. To fund these initiatives, management will utilize cash flows from operations, available borrowings, and unrestricted cash to invest in the core business, repay debt, pay dividends, and repurchase shares. Significant investments have been made in consumer and store technology, supply chain centers, and corporate store operations. Additionally, cost-saving strategies are planned to improve operating performance. Overall, management is confident in the company's ability to generate sufficient cash flows from operations to service debt and drive long-term growth. The company's financial summary reveals that it has engaged in two key shareholder return strategies. Firstly, the company has a history of paying dividends to its shareholders, as indicated on page 10 of the report. This demonstrates a commitment to distributing profits to investors and providing a regular income stream. Secondly, the company has also implemented a share buyback program, as noted on page 26. By repurchasing shares from the market, the company is able to reduce its outstanding share count and increase earnings per share for existing shareholders. This strategy aims to enhance shareholder value and provide a boost to investor returns. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary highlights potential issues related to inventory buildup and supply chain disruption. Notable indicators of these concerns include a significant increase in supply chain revenues, rising inventory levels, and increased costs associated with supply chain operations. In fiscal Q3 2025, the company experienced a substantial increase in supply chain revenues, reaching $2,053,055. This growth is attributed to higher order volumes and an increase in food basket pricing. Furthermore, inventory levels have also seen a notable rise, with a $1,465,191 increase from fiscal Q3 2024. These developments suggest that the company may be facing challenges related to managing its supply chain effectively. The increases in supply chain revenues and costs associated with operations could indicate inefficiencies or bottlenecks in the system. If left unaddressed, these issues may lead to inventory buildup and potential disruptions in the supply chain. That concludes the financial summary for DOMINOS Pizza Inc. Feel free to comment below, and I will be happy to answer them when possible.